Good evening, ladies and gentlemen. Sorry for the last time we met on live. The challenges that we went through. So I had no option than to do the recording, go back to the recordings, session. What I've realized is that most of you don't even um, view the video when it's sent to you. But I mean, whatever I have to say, even if we meet live, is the same thing that is being recorded, right? So I don't see any much difference. And you should note that the situation that we are in is a challenging situation. So you must also try and adjust a bit. Are you okay? So the advantage of the recording, you see, when we met the last time, most of you, your internet wasn't good, it was unstable. You cannot hear me, I can also not hear you, and so on. These challenges, we need to, avoid these challenges. So when I record, then you can play it at any time at your own convenience, and then you go through. So that's the essence of the recording. And well, we can have the live session and then I record as well, so that you have the recording. But because the internet is not strong, if you are recording at the same time having a live session, then there will be, it will be unstable. Even this one, I wasn't recording, and you saw that the internet was highly erratic. So just, try and acclimatize yourself to this situation. So when I send the video, please just go through. If you have any questions, you can jot them down. And when I meet you, we'll be having some intermittent meetings, right? Just as we did last Sunday, so that you bring up your matters, whatever you don't understand, you ask. Okay. So let's go to our lecture today. Now, in previous lectures, we talked about how to pay for your loan, right? And loan repayment actually, it's associated with interest. So once you have gotten a loan, then you have to pay an interest. And the interest in this case is the price that we are paying for using somebody's money. You know that the supply chain finance embodies three parties: you, the customer, and the customer can be an organization. In fact, this one, we are focusing on organizations as customers. You see, so it is not just like you, the individual sitting here, going to make a credit purchase from a supplier and so on. No, we are talking about organizations as suppliers, organizations as customers, and then financial institutions. So the monies involved are huge, right? So you, the customer, you contact or you make purchases from your suppliers. You see, but the payment agreement is said that it's going to take time. Let's say you have to pay within the next 6 months. And suppliers also give some um, uh, allowance, what we call, is it commission? No. Oh, I've forgotten. Some allowance for paying early, right? You get some credit if you pay early within some time. You can see that the three questions that I gave you as an assignment, we have, let's say if you say 2 net 8, I think I explained those things. The interest rate and then the time that you pay, you earn some discount. Yeah, discount is what I'm trying to remember. Right. So because you, the supplier, you don't want to wait till that duration, let's say 6 months. That would be too long for you. So you want the money to be paid to you on time. And a financial institution can support you by paying the money to you, the supplier, early. If let's say you want the money to be paid to you within 30 days, you see, then you are going to pay some discount to the to the bank. It's just like you have invested an amount, let's say in a fixed deposit account, and let's say it's about 3 months. But somewhere along the line, an issue occurred and you need the money back. So in this case, the bank will discount it. You're not going to get the full money as you put into the account. It will discount it. And here, the arrangement is that if we are taking 360 working days in a year or 365 working days in a year, then the prevailing interest rate, the interest rate that prevails within the agreement will be divided by that 360 days. And then we multiply it by the period which the supplier would like to be paid. If the supplier would like to be paid, let's say 30 days, then we multiply that by 30. And that will give you the rate that the bank is going to take as discount from your money. You see, so if let's say the whole amount is 200,000, and the prevailing interest rate is 20%, then that will be 20% divided by 360. That is if we assume a 360 working period. So divide by 360 and then multiply by 30 if the supplier wants to be paid within 30 days. You see, so the figure would then be calculated on the 200 million, and the bank will deduct that figure as well, discount, and then pay the balance to you. All right, then you, the supplier, the buyer, you are now going to pay the bank within the terms of agreement, that is within the 6 months period. But you can also decide to set equal sums of money aside, you see, and then invest in a fund. Invest in a fund which will also be attracting interest, you see, at regular intervals of time. And that is where the annuity comes in. When you are making regular payments at regular intervals of time over a period, then that comes under annuity. And I'm saying that we have two forms of annuity. We have the future value of an annuity, and then we have the present value of an annuity. Are you okay? So future value of an annuity actually represents future value of an annuity actually represents where you are depositing in order to raise a capital. So you, the customer, you can deposit equal sums of money into a sinking fund, and this money will be attracting interest, you see, knowing that you are to pay your bank at a certain point in time. So by that time, the balance in your account will have been exactly the money that you owe, so that you use it to just pay your bank. Or where you have also contracted a loan and that money must be repaid by making equal installment, that comes under what? Present value of an annuity. And present value of an annuity is what we call sinking fund. Present value of an annuity is what we call amortization, compared to sinking fund for future value of an annuity. And again, I indicated that there can be payment in advance and there can be payment in arrears. So if the period that you are making your payment, assuming is a sinking fund, and then you make your payment at the beginning of each period. So period here can be defined as yearly, right? It can be yearly. It can be semi-annual. It can be quarterly. It can be monthly, and so on and so forth. So all we know is that you are making your payment at the beginning of each period. Then you are making your payment in advance. So here, the interest that will accrue on your investment will be higher because the first installment will attract the interest for the entire full period. You see, if, for example, you are investing, let's say 10,000 cedis each every year for 5 years, how much would you have earned at the end of the 5th year? Note that here, because you are making 10,000 payments every year for 5 years, by the 5-year period, you would have paid a total of 50,000. So 10,000 times 5, 50. And you are making the payments at the beginning of the period. So you would have paid 50,000 in all. Then the first payment that you are making will also attract interest for the full 5 years. You see, and the last payment you make will also attract interest for the last only 1 year. That is how it goes. The second payment will attract interest for 4 years. The third payment will attract interest for 3 years. The fourth payment will attract interest for 2 years. And the last payment will attract interest for 1 year. Now, this one is different from where you are making your payment in arrears. In arrears means that you are making your payment at the end of the period. And again, period here is either yearly, semi-annually, which is 6 monthly, quarterly, 4 monthly, or monthly, and so on. Now, let's see what you'll be getting if you are making your payment at the end of the year. So, assuming the same 5-year period, and you are depositing 10,000 every year. By the time you make the first installment, 1 year has gone. So you can see that the first deposit you make will not attract interest for the first year. It will not earn any interest for the first year because the first year has already ended before you are making your payment. So in effect, that payment will attract interest for the next 4 years. You see, the second installment will attract interest for the 3-year period. The third installment will attract interest for the 2-year period. And the fourth installment will attract interest for 1 year. And of course, the last installment will also not attract any interest because you are making your payment on 31st December. So the installment that you make last will only go and add to your balance. And again, let's see how much you have paid in all. You have paid 40,000, sorry, compared to 50,000 for the advance payment because at the end of the first year, you make your first installment, second year, second installment, at the end of the third year, third installment for, it's the same 50,000, sorry, it's the same 50,000, but the interest will be less compared to when you are making your payments in advance, you see. And this is about when you are investing in order to raise a capital. And organizations does this most, they do this. If they want an expansion, they want to expand their production line, or they want to purchase new equipment, plants, you see, they may be setting monies aside, are you okay, so that they will invest, which will be attracting interest, so that by the period that they want to embark on the particular project, that money will be exactly, and in this case, there has been forecast about the total cost that will be incurred in that particular period, and so on. Are you okay? Now, when we come to present value of an annuity, then we are talking about amortization. And in this amortization, you are paying monies that you have taken. That is, you are repaying a debt or a loan. But the repayment is such that you are making equal installments over equal intervals of time. We all know that when you take monies from the bank, and the money is going to be spread over, let's say, 24 months or 36 months, you make equal installments every month. You see, the equal installment you are making, there is made up of two components, the principal and what? The interest. You see, so the interest reduces as you keep on paying because the interest is calculated on the outstanding balance and not on the original principal. That is why we say it is amortization. People mistakenly say that this is what we call the reducing balance method. So that is no. Under normal circumstances, the interest should be calculated on your outstanding balance. So if you have made your first installment, that will be deducted from the principal. And the principal here is that, or that will be deducted from the amount, not the principal, because the amount is the principal plus the interest, you see. So all we need to know is that if you are making equal installments at regular equal intervals of time, whether you are investing or whether you are repaying a loan, then it's an annuity. Are you okay? But we can also have a form of repayment of a loan where you are making this repayment a one-time payment, and that doesn't fall under annuity. So the first question, for example, is that you you owe your bank. You see, the bank has paid your supplier for you purchasing a good or a product from your supplier. Are you okay? But the bank has paid your supplier. So you have to pay your bank at a certain point in time. But you have decided to set equal. Somebody was saying yesterday that the interest rate are 2. Yes. So you have the rate that you are earning on your investment. And then you also have the rate on the loan itself. So you need to determine how much you'll be owing, let's say in the period, let's say if it is 5 years, by using the simple value formula to find how much you'll be owing. And then you are also setting equal monies aside, you see, so that is in a sinking fund, and that is the interest that you'll be earning on your investment. Okay, so this is very simple. So when you have done that, then you prepare the schedule. And the sinking fund schedule is a tabular representation of how the fund will be growing, as well as how the fund, the loan will be paid. You see, so that at the end of the day, the money will just be equal to your balance, and then you set up the loan. That is it. Okay. So I think this is just a recap of the last lecture. So just try the assignments and then submit, as you said, on coming Friday. Coming Friday, yeah. That's what you guys suggested. So by 6 p.m., you need to have submitted assignments. So there will be multiple assignments, right? Okay. So now let's look at what we intend to achieve today. Today's objective is about just knowing the components of the 3 basic financial statements. You know that every organization is supposed to prepare financial statements, and these ones actually play a role, especially the balance sheet, which we now call the statement of financial position, right? Play a key role in this supply chain business, because the buyer, you have bought the goods on credit from your supplier. So in the books of the buyer will create accounts payable, what to suggest that you are owing your suppliers. And then in the books of the seller, you see, the seller has also supplied you the goods on credit. So in the books of the seller will create accounts receivable to show that he has debtors who are to pay the account. So, and these components are, they constitute the balance sheet. That is receivables, which is a current asset, and then payables, which is also a current liability. So after knowing the components of the income statement, so the income statement, we need to just know the major components, what we classify as revenue, as from distinguished from gains, and then what we describe as expenses, as distinguished from losses. Those are the things we need to know. But the income statement, actually, we need to know the revenue, we need to know our cost of goods sold, which that is what we are calling the cost. Is it the cost for procuring the goods? Is different from the expenses you have incurred in selling the goods. Are you okay? Then we need to know the expenses column, and then the net profit or loss. And we know that the aim of the income statement is actually to measure the performance of the organization. So the profit and loss account will then determine whether you are performing or not. But that does not actually measure performance in terms of cash flow. You see, cash flow is the key in this lecture, because it is a cash flow statement which will determine whether you are able to settle your supplier within the accounting period, which is normally 1 year. So if you don't have balance cash, liquid, if you are not liquid enough to be able to settle your obligations when they fall due, see, then you are not in a good position. All right. So we look at the income statement, the balance sheet, and then the cash flow statement. And the cash flow statement, we also prepare it based on operating activities, investing activities. So the cash flow that has been generated, you see your cash inflows and your cash outflows from operating activities. And operating activities constitute the core of the organization's business, right? What you have been mandated to perform is what we would describe as operating activities. But if you are engaged in some investing activities, you have maybe purchased shares from other organizations, that's an investing activity. Or you acquire assets, procure assets to be used to generate revenue, that will give you what? An investing activity. And then financing, you have raised capital through the issuance of shares and so on. That will also be a financing activity. So we want to know the cash inflows and the cash outflows based on these activities. All right, then when do we recognize and when do we measure revenues based on these financial statements? So we need to account for the elements and the rules of recognition and measurement applicable to each financial statement. Okay, so let's take the income statement. So we are saying that we normally calculate our income based on the revenue or gains. And here we distinguish revenues from gains, right? Revenue actually constitutes what we have gotten or the proceeds that has been raised from the normal operating activities of the organization. You see, the core activities or the core business that the organization has been set up to embark upon. That is different from gains. If it comes to gains, then gains will be other peripheral activities. You see, that do not constitute the core activities of the organization, but then they are also giving the organization some monies. You see, so if, for example, an organization has been mandated to produce certain products, let's say because you are producing these products, you are also to come across other products that will be relevant to your core products that you are producing. So those ones will give you some gains, you see. Expenses are matched against revenue, and then losses are matched against gains. So expenses are based, when you talk about revenue and expenses, then we apply what we call the matching concept. The expenses that you have incurred as a result of raising the revenue. So when you are selling, you see, you have produced your products. The products must be distributed. And when you are distributing the products, you incur costs. So that is the distribution expenses. You must sell the products. When you are selling the products, you incur expenses. So that will be what? Selling expenses. So these expenses will be matched against the products that are being sold within a particular accounting period. Are you okay? The same applies to gains. So gains do not constitute the core business of the organization, but then they come by way of, somebody will say by accident. You see, so we also match losses to gains. All right. There has been some argument in the literature that the recognition of revenue must be what we call current operating income or all-inclusive income. So current operating income simply refers to only revenue that has been recorded from the core operations of the organization, you see, without any gains. But when we say all-inclusive, then we are combining everything and recognize it as what? Revenue. That is the argument. So we come to how revenues are recognized as we proceed. Now, there are two forms of preparing the income statement. We have what we call the articulation approach. So under the articulation approach, here we classify the income. We classify the income as mathematically equivalent to owner's equity. Owner's equity is a component of the balance sheet, right? Which normally must tally with net assets. So when you are using the articulation approach, but this is not all that important as far as we are concerned, right? But just that we need to have an idea. So it is mathematically expressed as owner's equity. So the net profit in the income statement is normally matched against owner's equity. And then we also have the non-articulation approach. But in the non-articulation approach, we only consider the income statement and the balance sheet as separate independent statements, right? So that one we do not match the net profit to owner's equity. Now, revenue expense approach focuses on defining the income statement elements. What are the elements of the income statement? You have your revenue, you have your gains, you have your expenses, and you have your losses. Those are the four key elements. Because when you have your revenue, you report your revenue that is coming from your core activities. Then you have other gains which didn't come from, because if you don't separate the revenue from the gains, the figures or your report will be misleading. You'll be misleading owners. You see, because the gains do not come on frequent basis. They don't constitute your routine activities. For example, let's say if there's an activity in this country, or let's say this pandemic, we can see that we are in need of nose mask. We are in need of sanitizers and so on. So these are not normal operating activities of organizations, but organizations have taken advantage of this situation to produce nose masks and then sanitizers and other PPEs. And that is going to raise your revenue, you see. So if you are reporting and you don't separate the gains that these are from as a result of these activities, then you are going to deceive your users, those that you are giving the statement to. So that is why we need to separate. And then the expenses that has been incurred in relation to the revenue must also be separated from some other losses that they did not occur as a result of raising your revenue, you see. Okay, so the revenue expense approach focuses on defining the income statement elements. So you need to define the income statement element. So in the income statement, you have your revenue, or what you call turnover. You see, then you have cost of goods sold. That is, cost of goods sold is different from expenses and losses. Now here, cost of goods sold must deal with the actual cost you have incurred in getting the goods that you are selling. You see, for merchandising firms, they deal with finished products. So they will buy the finished product and then resell it or retail it to customers. So the cost of goods will be the cost at which the finished products were acquired or procured. For manufacturing firms, you need to procure raw materials, you need to convert it. So we have the manufacturing cost, you see, which actually comprises, or we have what we call the production cost, which actually comprises direct materials, direct labor, direct expenses, and also overheads, you see. And these ones will constitute the cost of goods that have been sold. And this one is different from the expenses. Expenses actually constitutes what has been incurred as a result of selling or disposing of the products. You see, so when you have determined your cost of goods sold, then you come to get your gross profit. And we say that it's gross profit because there are other elements of expenses which must be what? Taken out of this gross profit. So when you have taken off your expenses, then we get to our net profit. You see, that's the idea. Okay, so when you have identified all the components in the income statement, we have what you call the assets and liabilities, which must be defined. We know that assets and liabilities are components of the balance sheet. So this must be defined because when you have revenue, it's an asset, right? When you have expenses, it's a liability. That is what we are saying in relation to the income statement. So these are defined, they are recognized, and then they are measured as a byproduct of revenues and expenses, right? Asset liability approach, which is the antithesis of revenue expense approach, is the asset liability approach, and that is antithesis of revenue expense approach because it emphasizes the definition, recognition, and the measurement of assets and liabilities. All right. This just it means what I've already explained. Income is defined, income is recognized, and income is measured as a byproduct of asset and liability measurement. You see, so here in the income statement, we recognize our revenue as an asset, which in the balance sheet is an asset, right? And then we recognize our expenses as what? Liability, which goes to the balance sheet. Because you may have accounts payable in the balance sheet, which is a liability. You may have accounts receivable in the balance sheet, which is what? An asset. So the antithesis of revenue expense approach, we say that it is the opposite. That is what it means here of the revenue expense approach. Okay, because it emphasizes what? The definition, it has to be defined, it has to be recognized, recognition, and then it measures assets and liabilities. Okay, now let's look at the difference between revenues and gains. As I've said earlier on, there are different components. So revenues actually result from the sale of goods. There has been argument about how revenue should be recognized. Now, in another school of thought, they say that revenue should be recognized during production. This argument came about because for some products, it takes a very long time for it to be for production to be completed. For example, the production of, let's say, ships. You see, if you are producing a ship or you are manufacturing an aeroplane and so on, these items take much longer time for it to be completed. So this argument says that revenue should be recognized during the production process. And you see, during the production process of this component, there might be several changes in economic activities which will affect the production cost. That is why the argument is there that it should be recognized during production. Other arguments also say that revenue should be recognized when production process is complete. So once there is a contract, let's say one country has contracted another country to manufacture an aeroplane. So once it has been completed, we recognize revenue. So, and it is upon completion that all expenses can be calculated associated with the products, can be recognized, identified, and then calculated. Another school of thought also says that we can only recognize revenue based on the sale of the product and where the legal title of the product has been transferred to the customer. And this is what we are currently, we base it on. This is what we call the prudent concept. So when the title of ownership has been duly transferred to the customer before revenue can be recognized. So that is another school of thought. So when you are measuring revenue, then when you have sold goods or you have rendered services, you see, And they are saying that this is measured by the charge made to customers. Of course, the customer must pay a price for the product or service which is being rendered to him. And clients or tenants for goods and services furnished to them. So you can have customers, you can have clients, you can have tenants. For example, if you talk about lawyers, lawyers have clients. So they also recognize revenue based on what they are charging to their clients and so on. Tenants, let's say you are a landlord, you have rented your room to a tenant, then you are recognizing your revenue as what the tenant is supposed to pay or the charge that has been made to the tenants for goods and what services furnished to them. So in a tenant landlord arrangement, it will be service. In a lawyer client arrangement, it will be what a service. But then in a manufacturing company and customer, it will be goods. Just as we have services provided by the public sector, you know that the public sector is more of providing services than goods. So services are more in the public sector than what physical goods, compared to the private sector, which also provides physical goods more than what services and so on. Then we can also recognize revenue as well. The gross increases in assets and gross decreases in liabilities. So you see, when your assets is higher than your liabilities, then your revenue is what being increased, because liabilities tend to knock off assets, right? So gross increases in assets and then gross increases decreases in liabilities, which has been measured in conformity with GAAP, generally accepted accounting principles. And generally accepted accounting principles vary from country to country. That is why we have the International Financial Reporting Standards, which has been adopted by many organizations in order to do away with the discrepancies, you see. So conformity with GAAP, that results from those types profit-directed activities. We can also measure revenues from this point of view. The inflows or other enhancements of assets of an entity or settlement of its liabilities. So this also goes to reinforce the second point. So your asset has been enhanced. So in that case, you have increased your assets. Are you okay? And then you have also reduced your liabilities. Are you okay? So during a period from delivering or producing goods, rendering services or other activities that constitute the entity's ongoing major or central operations. You see, so every organization, you have your core operations, what you have actually been mandated to do compared to other peripheral activities. Okay, so let's look at when to recognize revenue. Revenues generally are recognized at the point of sale when legal title is transferred. I think I've already mentioned this. So that is the current revenue recognition procedure. So when you have actually transferred goods, so in the supply chain agreement, we have buyer and then we have a supplier. And these agreements are based on credit, right? So you, the buyer, you are procuring the goods on credit. And then the supplier, you also supply the goods on credit. So there is trade agreement in terms of payment. But that is why the bank will come in to pay you, the supplier, and then the buyer will settle the bank in later time. So once there is an agreement for debts that has been incurred, then there will be interest, you see, associated with these debts. Okay, so when the legal title has been transferred to the buyer, and normally the buyer is about procurement of goods to manufacture your products. You see, so when you have the buyers, the suppliers transfer the goods to you, it means legal title has also been transferred. So the supplier can recognize revenue when the goods have been sent to you, but you are yet to pay, you see. So that is where the bank will also come in to pay the supplier. That is, if the supplier wants the money to be paid to him or her, and in this case, we are talking about an organization within a shorter period of time, then this agreement can be made between the three parties. See? So revenue generally, they are recognized at the point of sale when legal title is transferred. And revenue should be identified with the period. You see, the period that the revenue has been made, or the revenue has been, the revenue has been made in that period, during which the major economic activities necessary to the creation and disposition of goods and services has been accomplished. So if this creation and the disposition of goods have not been accomplished, we shouldn't. This is coming from the prudent concept. You should be prudent enough in recognizing revenues. Are you okay? So we identify with the period, you see. So when revenue has been earned, let's say in previous accounting years, and then revenue that has been earned ahead of the current accounting year, then we try to account for them to show that this revenue is not for the period we are considering, but it's for the previous period and then the period ahead of us. Okay, because we match the revenue against the expenses for the period that the revenue has been earned and the period that the expense has been incurred. Another one is that they say then, although the norm for revenue recognition is the point of sale, yes, that has been the norm. The primary criterion applied in practice is the completion of the earning process. Yes. Is it so? Maybe the goods have been delivered, but you have not yet earned the revenue. Is it so? When the earning process is complete, that is where you actually record. And as I've said, all this is coming from the prudence concept. So in other words, revenue should be recognized when the transaction or event that culminates the earning process has occurred. So revenues are separated from gains. Gains are the current operating and all-inclusive income concept. So you see, when what we are operating currently and what we have also in gain as a result of our activities, we combine everything as what gains. Okay. Then when we come to expenses and losses. Expenses include all expired costs which are deductible from revenues. So expenses are matched against what? Revenue. So they must deduct from revenues. Or it can be the gross decrease in assets or gross increases in liabilities, recognized and measured in conformity with GAAP, that result from those types profit-directed activities of an enterprise. So you can see that this is just the opposite of the revenue. You see, the gross decreases. In the revenue column, we say the gross increases in assets. But here is the gross decreases in assets. And then in the revenue, we say the gross decreases in liabilities. But here is the gross increases in liabilities. So it's just the opposite of the definition of revenue to this, right? So liabilities recognized and measured in conformity with GAAP. Okay. Or it can be the outflow. This is also an opposite to the revenue definition. Or outflows, or other using up of assets or incurrences of liabilities, you see, or a combination of both during a period from delivering or producing goods, rendering services, or carrying out other activities that constitute the entity's major or central operations. Okay, so here, this actually relates to the seller or the supplier. When do you recognize revenue? When you are dealing with another party who you sell goods on credit basis to that party, you see, in the supply chain. Okay, so let's go to the balance sheet. Now, balance sheet components actually comprises assets, and assets are separated into non-current assets. So when you talk about non-current assets, we have buildings, we have land, we have equipment, we have vehicles, we have computers, and so on. Now, we talk about non-current assets as those that are not movable. Take note that we are not talking about movement of vehicles around. No, it's something that is fixed, you see, compared to non-current assets such as your accounts receivable, your bank balance, your cash balance. If you have any prepayment, you see, you can make pay for some assets ahead, and so on. You see, those are current assets. Or your stock. The stock is what actually you get from your supplier on credit terms, which you're also going to use either in manufacturing or either for resale. You see, so yeah, so that is the difference between the two components of assets. We have the non-current asset and then we have the current asset. Then we have liabilities. Liabilities, we have those that the organization is able to settle within 1 year or as they fall due. And those are the current liabilities. So the relationship between your supplier is a current liability. The goods you have acquired, you have procured, must be settled within a period of 1 year. You see, so that is what current liability. And we have long-term liabilities, which is loans, long-term loans, such as debentures that has been contracted and that must be paid at certain intervals of time over a long period, normally more than 1 year. You see, so in your relationship with your supplier, the accounts payable is what will be in your books, and then accounts receivable is what will be in your supplier's books. Okay, so liability too are also categorized under long-term liabilities and then short-term liabilities. Then we have owner's equity. Owner's equity the figure in owner's equity constitutes those who are financing the business. So this figure must be equal to the net asset. So net asset is actually the difference between your assets and then your liabilities. All right, so that is about the balance sheet, but our concern is about accounts receivable, which is a current asset, and then accounts payable, which is current liabilities. So that is what we are much interested in as far as the components of the income statement and the balance sheet are concerned. Okay, so now let's go to the asset. Let's now define some of these components. Assets. Now, asset is something represented by a debit balance. So because in your books, you must debit your assets as coming to you. We say that debit the receiver and credit the giver. So that is why we debit it. So debit balance is or will be properly carried forward upon a closing of books. For example, when we are preparing accounts, it is based on the going concern principle or concept that the company is in existence, is operating into the foreseeable future. The account that we are preparing on a particular period of time does not bring or halt the operations of the company. Okay, so every financial statement that you pick, it is based on the going concern concept. So it is assumed that the organization will operate into the foreseeable future. So the assets that are recognized at the closing of books of account, you see, according to the rules or principles of accounting, on the basis that it represents either a property or is properly applicable to the future. You see, so those assets are in operation. They will continue to generate revenue. So they are economic events or economic resources that have been carried on to the next period. Example is what? Plant, accounts receivable, inventory, deferred charges, etc. You see. Or we can say that they are economic resources of an enterprise that are recognized and measured in conformity with GAAP. See, so those economic resources that has been carried forward as at the time that we are preparing the accounts or the financial statements, or there are probable future economic benefits that can be obtained or controlled by a particular entity. So if the asset is yours, you have the control over it. You see, nobody controls those assets with you because they belong to you as your property. So you can control it. But where the asset is not fully controlled by the organization, then you cannot describe it as what? Something that you can use to generate benefits or profits or revenues in the future. So probable future economic benefits obtained or controlled by a particular entity as a result of what? Past transactions or events. So this past transaction could be that the asset was procured from somebody and it has legally become yours. The same opposite definition will be applied to liabilities. Something represented by a credit balance that is or will be properly carried forward. You see, so a credit balance, accounts payable, for example, is carrying forward into the foreseeable future. So carry forward upon closing of books of accounts according to the rules or principles of accounting. Provided such credit balance is not in effect a negative balance applicable to an asset. Or it can also be an economic obligation of an enterprise that are recognized and measured in conformity with GAAP. And this is just exactly the opposite of the asset definition. Or probable future economic sacrifices. So you can see that in the asset definition, we said economic benefits. The opposite is that it's a sacrifices of economic benefits arising from present obligations of a particular entity to transfer assets or provide services to other entities in the future as a result of what? Past transactions or events. So these past transactions or events could be that is goods that you have procured from your supplier and you are yet to pay. You see, so this is carried into the future as a past transaction or event. All right. So that is the balance sheet. Now let's look at the owner's equity. As I indicated earlier on, owner's equity must be represented by the net asset of the organization. And that is a stakeholders or stockholders residual interest in the net assets of the firm. You see, so your owner's equity balance must be matched with the net assets of the firm. And it is the contributed capital. And it is also the earned capital, that is the retained earnings. There are various classifications that organizations put owner's equity into. Okay, so in a brief, those are the three components that are relevant to our study, to our supply chain finance. Okay, but we are here to look at statement of cash flow, which is the third component. So we have looked at the income statement, we have looked at the balance sheet. Now let's look at the cash flow. Now, cash flow statements, they constitute the most important aspect of all um, the statements, the financial statements. And this is a requirement by the International Financial Reporting Standard, that is IAS 7, that is also a component of the financial statement that a company must produce. Because cash flow statements actually indicates the movement of cash within the organization. That is the inflows and the outflows of cash. Because the income statement will only report the net profit or the net loss. Now, this figure will not give you information about the movement of cash. So an organization that has reported a profit, a net profit, may not have liquid or may not be liquid enough, may not have cash that it can use to settle its obligations as they fall due. An organization may also report loss, but then that organization, upon preparation of the cash flow statement, will indicate that it has cash to pay its obligations as they fall due. You see, so that is the essence why we prepare cash flow statement. Now, cash flow statements show the movement of cash, as I've already indicated. That is cash inflows and cash outflows within the organization. So it provides information about where a business obtained its cash during the financial period. So where are your sources of cash inflows? And how did you spend this cash? So how did the cash move out of the organization as cash outflows? You see, so that is what cash flow statement actually specify. Then I gave an example that a business can make a loss, you see, but still survive if it has sufficient cash or access to liquidity. You see, some organizations, they may not have cash available. They may also not have even access to cash, access to liquidity. So cash assets that can be quickly converted into cash. So when you look at the preparation of the balance sheet, for example, we normally report non-current asset first because they are the asset that they cannot be converted into cash at the shortest possible time. For example, if you have a building or you have a vehicle, equipment, how do you convert this into cash and in the immediate situation? It's very difficult to even sell a building and get a cash. You see, so the next item is what? Your inventory, because inventory is what you must sell to get cash. And this one, most organizations also use it as a deceptive. They deceive most owners because when you are preparing your income statement, for example, if you have large amount of inventory as closing, you see you have bought inventory goods, and all the goods are on the shelf. They have not been sold. But because you have bought them, you are including them in your inventory figure. So that is inventory stock. And when this figure is huge, and then it is being deducted from your revenue. Are you okay? Normally we say that we bring the revenues, right? And then we say cost of goods sold. So we have your opening inventory, you add your purchases. Then you then subtract the closing inventory. So the closing inventory is not actually deducted from sales figure, but then from your goods available for sale. So you get a very small figure for cost of goods sold. You see, that is how you are determining your cost of goods sold. And once the cost of goods sold figure is very small, you are going to get huge gross profit figure. You see, and when your huge gross profit figure, your gross profit figure is huge, then logically your net profit will be also what? Huge. But you are reporting net profit as the company has performed well. But this is where all the profit that you are reporting are tied up in your stock. The goods have not been sold, they are in stock. You see, so even if they have been sold, they are also in what? Accounts receivable. They have not been received. You haven't received the cash. So this will be a deceptive until you prepare the cash flow statement. The cash you have actually received, and then the cash you have actually dispersed, then to tell you the reality of the situation. You see, so a business can make a loss, but still survive if it has sufficient cash or access to liquidity, and so on. And then a business that is profitable cannot survive, you see, if it cannot pay its obligations when they fall due, because it does not have enough cash or access to other sources of liquidity. So statement of cash flows is very, very important when it comes to this supply chain finance, because even the bank that is going to finance your purchases will demand information about your cash flows to know how you are performing in terms of cash inflows and cash outflows. So this is also another component that we need to understand. Now, profit and cash flow. Profit and cash flow are different. We should take note. See, so when you ask, the explanation I gave or the example that I gave, profit is different from what? Cash flow. So the income statement cannot actually give you information about your cash flow. You see, so there are items of cost in the statement of comprehensive income that do not represent a cash flow here. So this is another example. We charge depreciation, amortization. Then we have what we call gains and losses. You see, the gains and losses have come here on the disposal or non-current asset. Good. When you have disposed of your non-current asset, let's say a vehicle has been disposed of, you can make a gain on the disposition of the asset, or you can incur a loss. You see, and that is when you have the cost of the asset. You see, if let's say the cost of the asset is, let's say, 20,000, and then you have a written down value, that is depreciation. So as at the time the car is being sold, the written down value has been, let's say, if it is 20,000, written down value has been, let's say, 150, 15,000. So the written down value is now 5,000, right? 5,000. But if you sell it more than the 5,000, you have made a gain. If you sell it less than the 5,000, you have incurred a loss. So that is the gain or loss that can be incurred from the disposition of a non-current asset. Now, these are all non-cash items that are recognized in the income statement. You see, so if your depreciation is huge, it's represented by a non-cash amortization and so on. So items of cash flow not appearing in the statement of comprehensive income. We also have some of the cash flows that do not appear. For example, acquisition or disposal of what? Investment. It will not be recorded in the income statement. You see, financial transactions such as issue of shares, loans, repayment of loans, and dividend and to shareholders. These are all not recorded in the income statement. They are cash flows, but they are not recorded in the income statement. They do not appear. You see, so because of that, profit is normally not the same as what? Cash flow. So how do we classify cash flow statements? A statement of cash flows, we group them into three. We have cash flows from operating activities. Your core business, what you are mandated to undertake. We also have cash flows from investing activities. So if you have acquired a vehicle, plant and machinery that is going to be used for the generation of income. And then we have also cash paid or obtained from what? Financing activities. If you have raised capital from the issuance of shares or debentures and so on. Now, it also shows whether there was increase or a decrease in cash in the amount of cash held by the entity between the beginning and the end of the period. So that is what the cash flow statement is all about. And the format is that, as I've already presented the groupings, we have cash flow from operating activities. Now, this can be negative and it can be positive. Are you okay? So your net cash flow from operating activities can have a negative balance or a positive balance. The same applies to investing activities, negative or positive. Financing activities, negative or positive. Then when you have these three, then you get your net cash flow, which could also be what? Either negative or positive. And then you add your cash flows and cash equivalent at the beginning of the period, and then your cash flows and cash equivalent at the end of the period. So that is where we go. But what is cash? We say that cash is defined as what you have in hand. So if you have a cash in hand, or petty cash and other cash not in the bank. Are you okay? And then cash in the business bank account. So that is what we are defined as cash. So when you have your stock and it has not been sold, you cannot define it as cash because it has not been converted into cash. And that normally is associated with what we call the cash conversion cycle. Cash conversion cycle is the shortest period that your stock or your inventory can be converted into cash. Then we have cash equivalent, items that are the equivalent of cash and could be converted into cash very quickly without risk of loss. For example, your check, if you have been given a check to go and cash, you see, so cash in a deposit account, so you can withdraw it by drawing a check, or a savings account. So that is what we call cash equivalent. For example, it is close to getting the liquid cash because you can just present a check to the bank if you have a money in your account and then withdraw. So those are the definitions for cash and cash equivalent. Then operating cash flows. So as I indicated that we have operating cash flows, we have investing cash flows, and then we have financing cash flows. So two approaches to identifying cash flows from operating activities. In fact, these two approaches actually relate to only the operating activities, the direct method and the indirect method. So with the direct method, we normally calculate the cash flow from operating activities. For example, cash received from debtors, and what debtors have paid, what we have paid to suppliers, what we have received from selling goods and so on. You see, so the direct method calculates the cash flow from operating activities by calculating cash received from customers. You see, cash paid to suppliers and so on. But when you talk about the indirect method, then it identifies the cash flows from operating activities. We normally adjust it by from the net profit, adjusting the profit before tax. We adjust the profit before tax because the tax component that you are paying is part of profit. You are paying that tax as a result of the profit you have made. You see, so you don't, if you do it profit after tax, then that will be incorrect because we are looking at your efforts in generating the cash. So this is the cash I've generated before it's being taxed. That's why you say profit before tax. So it arrives at the cash from operating activities figure, you see, indirectly by reconciling a profit figure to a cash figure. Okay. So this is a format. This is an example. Let's say we have a net cash flow from operating activities of 75,300. And then we will calculate the cash flow from investing activities. So all these are examples of investing activities. Acquisition of shares or debentures. That is, you have gone to acquire shares in a different company. So this one is not you floating shares to the public for subscription. That one will come under what? Financing. But where you can also acquire shares or debentures in a different company. You see, so, and then you purchase property, you purchase plant, you purchase machinery. And proceeds from sale of non-current assets, you see, and then interest received, dividend received. So you can receive interest from the debentures that you have acquired, or you can receive dividend from the shares you have acquired. So you get the net cash used in investing activities. That was negative, 32,500, right? Remember that some have been described as negative. For example, because you have gone to buy shares in a different company, it's an outflow. You see, so the shares and debentures that you bought is 5,000 cedis. That's why it's in negative bracket. Then you also purchase equipment, plants, and machinery. It's an outflow. You see, you paid for this equipment, so that is also in negative. But when you look at proceeds from sale of non-current assets, it is an inflow to you. So that is why it is not in brackets. And then interest received is also an inflow. So that is why it is also not in brackets. But the net is an outflow. So outflow of 32,500. We haven't finished. Then you are also calculating the cash flow from financing activities. Proceeds from issue of shares. So you see, this issue of shares here is different from the acquiring shares. So this one, you are rather raising capital by issuing shares to the public. So you got 30,000. That's why it's what? Positive. Proceeds from new loan. So you acquire a loan as well. That's also 10,000. But then you have repaid a loan. So that is negative, 17,000. Dividend paid to shareholders. You have paid your shareholders dividend, 25,000. That is also negative. So your net cash used in financing activities was 2,000, and it's also negative. So at the end of these three, your net increases or decreases in cash and cash equivalent is 40,800. You see, and the cash equivalent at the beginning of the year was 5,000. So at the end of the year, your cash at the end of the year will be 45,800. Now, this signifies the cash you have in the company that can be used for immediate transactions. You see, a company can report profit, but will not have this balance. Now, let's look at the indirect method. Now, when we are talking about the indirect method, then when we go to the beginning, the net cash flow from operating activities will be say that is 75,300. Indirect method, right? Yeah, on the indirect method. Now, I said that we adjust the profit. No, this is so. Or is it the direct method? Oh, okay. We are looking at the direct method first. Okay. So cash flow from operating activities. Here we report the cash we have received directly from customers. So all the monies we have received in terms of cash is 348,800. Cash that we have paid to suppliers is 70,000. So that is in brackets because it's an outflow. Cash payment to employees is 150,000. So that's what? An outflow. So it's in brackets. Cash paid for other operating activities is also 30,000. It's an outflow. Then we generated cash from operations. So that would be 98,800. You see, that is when you put all this together and you net it against the 348,800. That is the net cash flow from operations, 98,800. Before we pay tax of 21,000, and then we also pay our interest on loans, which is 2,500. So our net cash flow from operations is 75,300 positive. You see, and this figure tallies with what in the previous two slides. You see, so that is the from operations. But when we look at the indirect method, we actually adjust it from the profit before taxation. So the profit before taxation is 80,000. So we adjustment for all non-cash items such as depreciation, which is not represented by cash, but we are charging. So depreciation and amortization charge is 20,000, interest charge is 2,300, gains and disposal on non-current assets 6,000. You see, and When it is a charge, it's positive. When it is a gain, it's negative. Take note. That is, if you are using the indirect method, and then losses on disposal from this one is a loss, so it's positive. So the opposite is what we do. And then we have what we also include decreases or increases in, let's say, increase in trade and other receivables. You see, we have increases, so that will be negative. Decreases in inventory, that will be what? Positive. Increases in trade payables, positive. You see, because it's a liability that it has increased. And the net will be 98,800 from operations, as we saw it in the previous example. And then we pay tax, and then we pay interest charges. So net cash flow from operating activities was 75,300. Now, this direct and indirect method is applicable to only the operating section of the cash flow. As for the investing and the financing section, it's the same, right? It doesn't change. Okay, so I think this has brought us to the end of today's lecture. Now, I'll give you an assignment on cash flow by next week. So take note. Using the direct and indirect method to prepare all the cash flow for, let's say, a certain organization. All right, so we will continue later. So take care and then go through the slides, please. It's very important. All right, thank you.